The economic crisis and recession certainly cause stress. What if those stresses returned? And how will Europe's fragile banking sector handle another recession? That's why Europe has been putting 91 of its big banks, about 65% of the banking sector, through so-called stress tests to see how many might fail under various hypothetical economic shocks. Now, Europe has to do this because banks are afraid to loan to each other, and everyone wants to know how much government debt the banks are carrying. And more importantly, is it Greek debt or German debt that sits on the books? Then there's all those dodgy property loans floating around. Will banks have adequate amount of capital to withstand this stress? And just how fragile is Europe's banking system? After the results are released on Friday, the hope is the banks will start to lend to each other again, and that analysts and rating agencies won't have to guess how healthy each bank is. The better banks would then be able to issue their debt at lower rates. But the actual tests themselves have been under the microscope too. If the vast majority of the banks pass the stress test, it's likely the test will be seen as way too easy. If many fail, then have they done nothing more than scare an already fragile market? And finally, what will European governments do with their banks that fail? Jim Bolden, CNN, London.